Alright, what up, Internet fam? It's your favorite slightly cynical, always on point financial advisor, back again to drop some truth bombs. Today, we're talking about something that makes most people clutch their pearls harder than a Victorian-era socialite at a rave: recessions. Yeah, I said it. Recession. But here's the thing, while the news anchors are hyping up the doom and gloom, and your Uncle Barry is panic selling his entire portfolio, the real MVPs, the smart investors, they're not just surviving, they're thriving. They're quietly buying up assets on sale, building generational wealth, and basically having a financial glow-up while everyone else is having a meltdown. And today, I'm gonna show you how to be one of them. This isn't some get-rich-quick TikTok trend, okay? This is fundamental, slightly boujee, market wisdom. So grab your boujee coffee, maybe a weighted blanket if you're feeling extra, and let's get into it. By the end of this, you'll not only understand how smart investors profit from recessions, but you'll have a game plan to do it yourself. No cap. Section 1, The Anatomy of a Recession, and Why You're Scared. First off, let's demystify this scary word. What even is a recession? Officially, it's 2 consecutive quarters of negative GDP growth. Basically, the economy shrinks. Businesses slow down, people get laid off, your barista might look a little more stressed. And look, it's not exactly a picnic. Nobody's saying it's fun. But here's the tea: recessions are a natural, cyclical part of the economic landscape. They happen. They've always happened. They always will happen. It's like the stock market's seasonal flu. Annoying, but not usually fatal. The media, bless their dramatic hearts, loves to amplify the panic. They thrive on headlines that scream crisis and economic collapse, because FUD, fear, uncertainty, and doubt, gets clicks. And frankly, most retail investors, bless their naive hearts, fall for it. They see their portfolio dip 10%, 20%, even 30%, and their primal brain screams, sell everything. Avoid losses. And that, my friends, is exactly where they go wrong. They become emotional bag holders, selling low what they bought high, locking in losses, and guaranteeing they miss the recovery. It's giving financial self-sabotage. Section 2, The Smart Money Mindset Shift, from Fear to Opportunity. Now, how do the big dogs, the institutional investors, the people with actual financial rizz, see a recession? They see a sale. A Black Friday for assets. While everyone else is running for the hills, they're sharpening their pencils and prepping their shopping lists. Their mindset isn't, how do I avoid losing money? It's, how do I maximize my gains from this inevitable dip? They understand that economic downturns are temporary. Historically, the stock market has always recovered, and then some. Every single time. Think about it: the dot-com bust, 9/11, the 2008 financial crisis, the COVID crash. Each one felt like the end of the world in the moment, right? But if you had invested during those dark times, and just held on, you'd be sitting pretty right now. It's about having a long-term vision, not getting caught up in the daily TikTok trends of market volatility. Section 3, Strategy 1, The Discount Shopper, Equities, Stocks. This is the most straightforward, yet often the hardest for people to execute. When stocks go down, they're cheaper. Revolutionary, I know. But seriously, think of it like this: if Apple stock drops 30% because of a recession, is Apple suddenly a bad company? Are iPhones going out of style? Probably not. It's the same great company, just on sale. Asterisk dollar cost averaging, DCA. This isn't just for bull markets, people. During a recession, DCA becomes your superpower. Instead of trying to time the bottom, which, spoiler alert, nobody can consistently do, you just keep investing a fixed amount regularly. When the market is down, your fixed amount buys more shares. So, when the market inevitably recovers, you have a larger position at a lower average price. It's like getting bonus shares just for showing up. Don't be that person who stops investing when things look bad. That's literally the worst possible time. Identifying resilient sectors and companies. Not all stocks are created equal. During a downturn, people still need food, utilities, healthcare, and basic consumer goods. Companies in these defensive sectors often hold up better because their demand is less elastic. Look for companies with strong balance sheets, low debt, consistent cash flow, and a track record of surviving previous recessions. These are the blue-chip boujee bargains. The ones that might dip, but have the staying power to bounce back hard. Avoid the speculative meme stocks that soared on hype. They're usually the first to get absolutely wrecked. Quality over quantity. Focus on high-quality companies. Companies with a competitive moat, strong management, and products or services that remain essential even when budgets are tight. Think Starbucks, Johnson & Johnson, Coca-Cola. People might cut back on designer clothes, but they still want their coffee, their medicine, and their soda. These are the foundation of a recession-proof portfolio. Section 4, Strategy 2, Defensive Plays and Income Generation, Bonds, Dividends, and REITs. While growth stocks are taking a hit, other assets can actually shine, or at least provide some stability and income. Bonds. Historically, when the economy slows, central banks often lower interest rates to stimulate growth. This can make existing bonds, especially government bonds, like U.S. Treasuries, more attractive because their fixed interest payments become relatively higher than new bonds. Also, in times of uncertainty, investors flock to safe haven assets, and government bonds are often seen as the safest. High-quality corporate bonds from very stable companies can also offer decent yields with less volatility than their stock counterparts. They typically pay a fixed interest rate, providing a predictable income stream even if the market is going sideways. Dividend aristocrats and kings. These are companies that have consistently increased their dividends for 25+ or 50+ consecutive years, respectively. We're talking about companies that have sailed through multiple recessions and still kept paying their shareholders. Their stock price might dip, but that juicy dividend yield often keeps flowing. And guess what? When the stock price dips, the yield on those dividends effectively goes up for new buyers, making them even more attractive. It's like getting paid to wait for the recovery. Who doesn't love passive income? REITs, real estate investment trusts. Okay, a bit nuanced here. REITs are companies that own, operate, or finance income-producing real estate. They pay out most of their taxable income to shareholders in the form of dividends. Now, some REITs, like those focused on data centers, cell towers, or essential logistics warehouses, can be quite resilient. Others, like retail or hotel REITs, can get absolutely crushed. So, do your homework. But the right REITs can offer strong dividend income and diversification away from traditional stocks, especially if they're in sectors that aren't directly impacted by consumer discretionary spending dips. Section 5, Strategy 3, Cash King, Liquidity is Power. This might sound basic, but having a substantial cash reserve is critical. And I'm not talking about your emergency fund for a flat tire. I'm talking about dry powder, cash specifically earmarked for investment opportunities during a downturn. Opportunity Fund. Imagine the market just tanked 30%. You've got a list of amazing companies you want to own. Now, imagine you have zero cash because you were fully invested during the boom. Tough luck, fam. But if you've got that war chest ready, you can swoop in and buy those quality assets at bargain prices. It's like having VIP access to the clearance sale of a lifetime. High yield savings accounts. While you're waiting for the perfect buying opportunity, your cash shouldn't just be sitting there losing purchasing power to inflation. Park it in a high yield savings account or short-term T-bills. During periods of rising interest rates, these can actually give you a decent return while maintaining liquidity. Cash is queen, king, and the entire royal court during a downturn because it gives you options and flexibility. Section 6, Strategy 4, Shorting and Inverse ETFs, Advanced/Risky. Now, for my more advanced, slightly chaotic investors, there are ways to directly profit from declines. But let me be crystal clear, this is not for beginners. This is like trying to do advanced calculus before you've mastered basic arithmetic. Proceed with extreme caution, or better yet, maybe just don't. Short selling. This involves borrowing shares of a stock and selling them, hoping to buy them back later at a lower price and return them to the lender, pocketing the difference. If the stock goes up, your losses are theoretically unlimited. You can get absolutely wrecked. Seriously, don't play with this unless you know exactly what you're doing. Inverse ETFs. These are exchange-traded funds designed to move in the opposite direction of an index or sector. So, if the S&P 500 goes down 1%, an inverse S&P 500 ETF might go up 1%, before fees and tracking error. Some are even leveraged, meaning they try to go up 2x or 3x the inverse move. Again, extremely risky, not for long-term holding, and they come with complex daily rebalancing issues that can erode returns over time. These are typically for highly active, short-term traders. My personal take. For 99% of you, focus on the first 3 strategies. They are infinitely safer and more reliable for building long-term wealth during a recession. Section 7, Don't be a victim, the psychological game. Honestly, the biggest hurdle during a recession isn't finding good investments, it's managing your own brain. Your emotions will scream at you to sell. Your friends and family will tell you to play it safe. The news will be a constant stream of negativity. Tune out the noise. Unfollow the financial doomsday prophets on Twitter. Limit your news consumption. Focus on your long-term plan, not the daily market gyrations. Daily volatility is just noise, and smart investors ignore it. Stick to your plan. If you've done your research and developed a strategy, stick to it. Don't let fear or FOMO, fear of missing out, but ironically, fear of more losses in this case, derail you. Have conviction in your research. Education is power. The more you understand about market cycles, economic indicators, and investing principles, the less scary downturns become. Knowledge builds confidence, and confidence helps you make rational decisions when others are panicking. Conclusion: your recession glow-up starts now. So there you have it, besties. Recessions are not just periods of economic pain, they are golden opportunities for those with the right mindset and strategies. While the masses are selling their stocks in a panic, the smart money is quietly accumulating high-quality assets at a discount, setting themselves up for massive gains when the inevitable recovery hits. It's not about being lucky, it's about being prepared, being disciplined, and understanding the game. Stop letting fear dictate your financial decisions. Start seeing recessions for what they truly are, a chance to accelerate your wealth-building journey. Implement these strategies, stay disciplined, and watch your portfolio thank you later. This isn't just about surviving a recession, it's about winning it. If you found this helpful, smash that like button, subscribe for more financial wisdom, and let me know in the comments below, what's your go-to recession strategy? Are you buying the dip or panic selling? Let's spark some intelligent conversation, not just keyboard warrior drama. Until next time, stay smart, stay solvent, and keep chasing those financial goals. Peace out.